Good morning, gentlemen. Thank you very much for your time. I really do appreciate, given what's happening out there in the markets, things are extremely volatile with no sort of indication as to where this COVID, debacle would take us, and what the actual final implication would be on global markets. Pierre, would you mind talking us through and possibly just unpacking some of the relevant components that has to be considered when constructing a portfolio at this stage, given what's happening? Obviously we're trying to enhance capital and beat benchmarks relative to client needs, but obviously we need to also protect wealth, at as much as possible. Would you be able to talk us through your sort of thinking and sort of investment approach during these sort of times?
Thank you very much, Luciano. Certainly. So I'm going to cover a few very high-level things, and then you're very welcome to ask specific questions as well, if you like. So firstly, I just want to touch on COVID-19, because really the current environment that we find ourselves in obviously was driven by that and the global spread of that. Then we'll move on to the markets, what's happened in the first quarter, and subsequent to that, what's been the monetary and fiscal stimulus across the world, what does valuations look like, and then what is the nature of bear markets and bull markets. And I just want to make a few relevant points when one starts thinking about portfolio management that you need to take into account. And then lastly, I'll say a few things about the Rand.
Good.
This slide shows the development of COVID-19 in South Africa. It's slightly out of date. As at yesterday, we are cumulatively on 3,600 cases. But as you can see from the blue line, we've followed a very different trajectory from, for example, the UK, and that's due to the very early lockdown and quite aggressive lockdown that we implemented. So it looks promising, but it's early days, and we need to see how it develops. And obviously, the impact on the real economy and how countries are going to proceed from here onwards and start opening up the economies again once the infections have peaked is really what is critical for us from an investment point of view. And what the world and investment people are worried about, and certainly the medical people as well, is the example of what happened in the 1990s with the Spanish flu, where it wasn't brought under control in one wave, but there were recurrences over a period of a year, a second and a third wave. And that's the challenge that faces policymakers currently as to how we are going to open global economies while not running excessive risk of just kind of having a second and a third wave taking us back to square one again. And that's obviously why South Africa is also taking a cautious approach. And in this week, we'll be hearing more from our president as to how we are going to go about opening up our economy. So that's the medical side and what we need to take into account. Then in terms of what happened in the markets in the first quarter or so far since COVID-19 became the topical driver of what's going on, and markets has come off significantly. What we show on this graph is South African asset classes, the solid lines, and then global asset classes, the dotted lines. And this graph goes back to 2017. And what you can see is we had fairly kind of sideways markets in South Africa, and then we had these steep drop-offs in the first quarter of this year. So after fairly disappointing outcomes for investors up to the end of last year, and just when we thought the global economy is going to start growing a bit more synchronized, the COVID-19 bear market hit us. Interesting enough, the global markets, as you can see, the dotted lines are up, measured in Rand terms, but that's obviously because the Rand weakened by 30% since the start of the year. So those markets are in fact also down, but the weakening Rand gave a positive return to a Rand investor. And that obviously helped the global portions of our portfolios somewhat to dampen the pain. Subsequently to that, this is a graph of the all share. Subsequent to the fall in the market, it bottomed on the 23rd of March, and subsequent to that, we've had that recovery, which is close to 30% now from the low. It's 29% of the all share. And there's a number of things to read into this. Firstly, it's very, very difficult to time turns in the market. If one panicked out right at the bottom, there was a lot to be lost in the subsequent recovery. Now, whether that is going to stick and whether we've seen the bottom is a question that everyone wonders about, and I'll speak a bit more about that when I look at the nature of bear markets and bull markets. So why did markets bottom in late March and recover quite strongly from there onwards? There's a number of reasons, but probably the most important reason is the fiscal and the monetary response by reserve banks across the world. And what we show here is the stimulus by the US Federal Reserve. And it's just one element of the overall stimulus. But as we can see, this shows the increase in the Federal Reserve's balance sheet as they start buying up bonds to put liquidity into the economy. And as we can see here, the light green line is the current response, and we compare that in the darker line with the response in the financial crisis of 2008. And as you can see, the response of the Fed this time around has been a lot quicker, a lot more dramatic and aggressive, and that is why they effectively put a floor under the liquidity concerns in the market at least, and why markets stabilized. What does valuations look like? This graph shows the percentage of companies in each of these markets that we show that are in bear market territory, and the definition used here is markets that are at least 20% off their previous highs of the previous 5 years. And second from the left, you can see the South African equity market is very cheap. 98% of our companies are at least 20% lower from their previous highs. So equity markets are cheap. This is also validated on this slide for emerging markets generally, of which South Africa is part. As you can see on the graph right on the right-hand side, emerging market equities, generally speaking, is now cheaper than what they were in 2008 at the bottom of the financial crisis, and they are close to the lows in the early 2000s when there was also a significant emerging market crisis. So just a few words on the nature of bear markets and things that one needs to be careful of. It's natural to think that after a strong bounce like we've seen from the end of March, that the market might come off again and one might test new lows, and that could well happen. It is a rational concern to have from the point where we stand now. But what we do on this graph is we compare the current development of the market, which is the grey line on the left-hand side, to previous serious bear markets. The brown is the 1929 bear market following the Great Depression, and the green line is the bear market after the 1987 crash. And the point to make is that in the 20s, as you can see, the market crashed. Then it recovered very strongly over the course of half a year by more than 60%, but then it tested new lows again. And academic opinion looking back is that there was policy mismanagement from policymakers in the 1920s and things that we have hopefully learned from. The 87 experience was very different. The market crashed. After that, there was a lot of volatility, but it never tested new lows again. And therefore, we need to conclude that from the current lows, after the market has fallen quicker than in these two previous incidences, we cannot with certainty say that the market will come off again and test new lows. It quite well be that we follow some sort of a experience of the green line after 87, and that if one sits too cautiously on the sidelines with de-risked portfolios, you never really get a better point to enter the market again. And hence why we say market timing is very dangerous to do.
So maybe just on that point, Pierre, if you don't mind. I mean, so obviously we don't know what the world's going to be looking like after COVID. I mean, COVID's not going to pack its bags and just disappear. It's going to remain. So the world that we live in would obviously change forever. And that's a risk one could obviously not quantify. But relative to what you're saying now, how do we sort of interpret that information with regards to the graph that you showed in terms of historical events?
Good question. Firstly, as I explained, asset allocation need to be appropriate. So one needs to weigh the risk of being out of the market with the risk, I suppose, of being fully in the market. And I think the reality is one needs to be somewhere in between. Clearly there's uncertainty, and we don't want to be as aggressive as we would be if there's no risks. But clearly also there's risk of being too light in risk assets, because, as I mentioned, it might well just be that because of the massive liquidity in the market, things improve from here onwards. And there's a big risk of being out. If we just deviate a bit and think about the shape of the economic recovery to come, what we expect is some sort of a U-shaped recovery. And what that means is very bad economic news coming out in the second quarter or post the second quarter, then some stabilization in the third quarter of this year, and then a strong recovery in the fourth quarter as the liquidity stimulus kicks in and as economies start opening up, and from a very low base they start growing again. Now, the very important thing is the market will look forward by 6 to 12 months and discount this news. So if I talk about economic recovery in the fourth quarter of 2020 and the first quarter of 2021, it could well be that from mid-2020 the markets start discounting that as the picture becomes more clear. Now, that's from an asset allocation view. Very importantly, to your question as well, what kind of companies will managers buy in this coming uncertain environment? And clearly, one will want to tilt, and Dion will speak more about that in the next session, but one wants to tilt towards better quality companies. What are those? Those are the consumer staples. Those are the kind of companies that people will have to spend on. Medical, for example, Dis-Chem, in the South African context, as an example, the food retailers, Pick n Pay, Shoprite, and so forth. What companies will one want to avoid for the time being? Probably companies, luxury goods, things that people will cut down on. So the more pure discretionary luxury goods, airline shares, cruise ship shares, those kind of things, the things that are in the heat of the COVID-19 troubles. Those are the kind of things that one will try and avoid, and that markets that managers will avoid for the foreseeable future. I just lastly want to conclude with this, to make the point about, on academic evidence, where does one make money in a market cycle? And this is quite interesting. So what this graph shows is, if you imagine a stylized market cycle that starts very low after a crash and then recovers and slopes upwards towards the right top corner, and then peaks on the right hand side just before the next crash in the market. If you divide that into 10 equal time pieces, what this graph shows, if we look at historic markets, is that you make a lot of money right after a crash, in the first correction, in the first 10% of time after the market crash. And that's a bit what we've seen now since the end of March. After that, you make more muted returns in the rest of the cycle. And then, interestingly enough, right at the end of the cycle, when the party is at its red hottest and everyone is excited about the market that's been going up for quite a while, there you also make outsized returns. There's more risk in that late stage of the cycle, because that's clearly where the speculative money has its apex and drives the market maybe higher in a less than rational way. But the point is, if you miss either the very first or the very last 10% of market cycle time post a crash, you will end up with fairly average or below average returns. So and lastly on the Rand, to conclude, the Rand is weaker than what it should be if inflation is the only driver. This line looks at a concept called purchase power parity, which uses inflation differentials and interest rate differentials as the inputs, and it's quite accurate over time, as you can see, but there's quite a bit of volatility around it. But the Rand, on this basis, fair value for the Rand is 13 Rand to the dollar. It's currently at 19 Rand. It's as weak as it was in 2016, 29 after the financial crisis, and in 2001. But as you can see on the line, the Rand typically does not stay at these very extreme low levels when it gets there, and therefore there is some risk that the Rand might strengthen, and it might do so on the back of other emerging market currencies if China is a big driver of the economic recovery and all emerging markets get pulled up by China. So in conclusion,
maybe just on that as well, Pierre. Is it something to consider to possibly tilt towards South African or emerging market equities? Maybe
yes.
repatriate some of the capital that's been exposed to offshore capital based on the current
Yes.
currency valuations, and also the fact that as you pointed out earlier, our equities are so cheap. Is the barrier to entry not that attractive?
Yeah. Yes, absolutely. So our equities show good value. Obviously, there's uncertainty that one needs to calibrate your positions for. Incidentally, our bonds, and we didn't spend a lot of time on bonds in this presentation, but South African bonds offer a very good yield. So there's a good point to be made to bring a bit of money back from overseas and putting it in South African fixed interest and especially longer duration bonds. And that's in effect what we have been doing in portfolios. So we're not bringing back material offshore exposure, because certainly developed markets are more defensive, and there's good risk management reasons why we keep exposure to them, but we don't want to be at absolutely full offshore exposure as per the limits that we need to adhere to. We probably want to be 5 or 6 or 7% below that. And then in summary, as I hope I illustrated, market timing is very dangerous and difficult and near impossible. One can easily miss out on bounces, and therefore you might have heard before that the saying is, it is time in the market that matters, so that you smooth out the volatility and not necessarily timing the market. What matters for portfolios now? To have a healthy balance between offense and defense, as I mentioned, even down to the stock level, balancing it between companies that are more cyclical and will do well when the recovery really takes hold, but balancing that with companies that are more defensive and will give some relative protection in the immediate short term. And then what key recommendations should one make? I think to stick your investment plan as per your risk profile, and avoid trying to make too aggressive changes to portfolios, especially in these volatile times where the markets can move 2.5%, 3%, 4%, 5% per day. Those are the kind of annual returns that we received in the last 5 years per annum on an average basis. We're getting those kind of moves now in a day or 2 or 3 or in a week. So one needs to be very careful about the ins and outs into and out of the market in such a volatile environment. Thank you very much.
Thank you for that, Pierre. I really appreciate. Dion, would you mind talking us through the actual practical interpretation of the technical data into the portfolios? Often it's difficult to consider how these technical components roll out into the portfolios. So would you mind talking us through that?
Yes, good morning. Thank you for the opportunity. For today, I'm going to focus on mainly 3 portfolios: the Naviga Balance, Growth Portfolio, and Low Income. As you see, the Naviga Growth Portfolio actually delivered a positive return for this year, a positive return of 6%, and that was mainly due to the offshore exposure. Within this mandate, there's no offshore limit, and managers can actively manage the asset allocation with no limit. So currently this portfolio has got about 65% in the offshore market, and that assisted the portfolio to deliver a positive return. The Naviga Balance and Low Income portfolio is a high equity portfolio, and they were more impacted by the local market. So the local market fell by 16.4% for this year, but the asset managers were able to protect by diversifying between different asset classes. So the loss for Naviga Balance was 9.8%, and for Naviga Low Income, we were slightly more conservative because it's mostly for post-retirement clients, and the return was minus 8.2%. So it did lose capital for this year to date, but it was much less than the equity market. Going forward, the expectations is that markets will recover. This one is from Prudential, one of our underlying fund managers. For the cautious fund, they expect inflation plus 7% return before fees. And for the balanced fund, this should even be higher due to the SA equity exposure, where they expect a return of inflation plus 14% over the next 3 to 5 years. As you can see, the offshore exposure, the return expectation is less from the offshore exposure. And one of the reasons is that the rand is extremely weak at the moment and that it can appreciate versus the dollar. And what happened in previous time in 2008, although both the local and global markets recover about the same amount, the rand strengthened when the market recovered, which detracted from global equities. And as you can see, the global equity has delivered much lower return than that from SA equity. So be careful to rush to global equities because the rand can get stronger from these levels. Just for clients before retirement, this is not necessarily a bad time to invest, especially if you do a debit order, because you benefit from a lower cost of units. So when markets fall, like it did in 2008 as well, the investor would pay less for those units than someone that waited for markets to recover. Someone that waited for markets to recover would have paid more for those units and would have owned less units. So when the market recovered, an investor that invested during a falling market performed much better than someone that waited for the markets to recover. For post-retirement, we follow a different strategy. Instead, we split the assets among different silos. So we've got a short, medium, and long-term silo, and we only draw the income from a short-term silo. So there's no need to sell equities at a loss at the moment to fund the monthly income. There is a silo that made provision for the income that provides stability in the portfolio. So a short-term silo is typically your money-like type of investments. We use flexible income funds that tend to outperform money market funds by 1%. And this is for your short-term needs. Then we've got a medium-term silo. This silo takes slightly more risk, but it should still protect capital over any 1 year period. And then the balance of a portfolio, we invest in the long-term silo. And that is global, local equities, and property. And here we try to achieve long-term capital growth. And one of the reasons why you need to include equities is that over the last 20 years, despite a recession in the early 2000s, a market crash in 2008, and now the more recent market crash, equities outperform money market by a substantial amount during the last 20 years. And as Pierre also mentioned, is that economic news markets doesn't always look at economic fundamentals of the short term. They are forward-looking. So it means that even if news is bad and economic indicators is negative, markets can recover during this low growth environment because markets are forward-looking. And especially if you consider all the stimulus in the global markets expect the economies to recover within the near future. So how do we manage a portfolio in these volatile times? We diversify among asset classes, and we diversify between different investment styles. And by combining these different investment styles, you get a much more consistent return in the portfolios. We also diversify between different type of asset managers, from small managers that's more flexible and they can move between stocks and asset classes, to large asset managers that's well known and that's got large teams to analyze the markets. And then we've also included index funds that reduce the cost of the portfolios, like Satrix and Netgroup. So what actions have you taken in the portfolios? We allowed the underlying fund managers to actively manage the asset allocation. Most of the asset managers upweighted their equity exposure. They didn't panic at the bottom. They didn't sell equities at the loss at the bottom, and rather retain the equity exposure or even marginally increase the equity exposure to benefit from the recent recovery in the markets. We are tilting the portfolios to quality, as Pierre mentioned. Quality companies should survive as lockdown and COVID-19. So we opt for more safer companies. So we go tilting the portfolios to quality. We're increasing our exposure to SA bonds. SA bonds are extremely cheap at the moment compared to other bonds in the world. Currently, we get about inflation plus 6 to 7% from our bonds, which is extremely cheap relative to the rest of the world. We retain our equity exposure. We're not reducing our equity exposure, and we are marginally reducing our global exposure due to the weak rand. So in Navigo Growth portfolio, did exceptional well this year, delivering that positive return of 6% despite COVID-19, but we've reduced it slightly. We've reduced the global exposure in favor of local equities that's very cheap. So to conclude, one needs to focus on the long term. Don't reach too much news. Try and avoid social media. Don't panic. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful, and stay invested. A loss will only be realized when you sell the units, and then equities is required, as I mentioned earlier. And then lastly, don't time the markets. JP Morgan did a study. 6 out of the 10 best trading days happen usually after the worst 10 trading days. So the best days in the market happen after the worst days in the market. And then also, if you miss just some of the best days in the market, Coronation did a study that if you miss only 25 best days in the markets out of 6,000 days, the return drops from 14.5% to 8%. If you miss 75 out of 6,000 days, that return drops to 0%. So only missing 75 days out of the best days out of 6,000 days, the return reduces to 0%. So be careful not to time the market. It's extremely difficult. That's
Jan, if I could just come in there. So in just going into a bit more detail, and maybe this is maybe we must roll this out into a different discussion. But going into a bit more detail in the income portfolios, you referred to the silo approach, and it makes absolute sense. What is relevant though, and what I see in my client's portfolio, for instance, obviously the low income model makes provision for in the range of 7.5% maximum income drawn from that portfolio, as an example. Now, due to the pullback in the market and the valuation of the portfolio that retracts, the 7.5% now increases to above that 7.5% in terms of income. So it goes to, for instance, 9.5% or so forth. How do we approach that? So when you're sitting at the top of the threshold, if I can call it that, is there do we keep the asset allocation as it stands? Because switching mandates at this stage, in my opinion, would be detrimental, because you'd be selling off, realizing losses and moving into interest-bearing instruments, locking in those losses. So what's your view, maybe just on that?
I would keep it in the same portfolio because there's enough income left in that short-term silo. So there's enough provision made, even if the income increases marginally. I would wait for markets to recover, because as markets recover, that percentage will decrease again. So although it might increase to, let's say, 8% or 9%, as markets recover, that percentage will go down again, let's say to 7.5%. So at the moment, try not to switch between different mandates. Try to stick to the current asset allocation. There is enough income available in the short-term silo for the short-term needs, and that allows the equities to recover. So there's no need to sell equities now at a loss.
Good. Fantastic. Gentlemen, thank you very much for your time. I really do appreciate it. I should be checking in with you soon. But thank you so much for your input. I really do appreciate it.
It's a pleasure.
Thanks, Luciano. Thank you very much.
Speak to you soon. Take care. Bye-bye.